Welcome back to the deep dive. It is so great to have you with us again today.
Yeah, really great to be here.
You have brought us an incredibly timely topic this time, and a stack of notes that genuinely kept me up reading late into the night.
It's dense stuff.
It really is. We are digging into a source you provided called the Conflict Playbook Strategic Investing During Geopolitical Tensions, and we're applying the framework from your notes directly to the current headlines regarding the U.S.-Iran tensions.
Right, which is obviously a very active situation right now.
Exactly. Now, the goal of today's deep dive is actually quite specific. We are going to try to cut straight through the noise, the anxiety, the absolute frenzy of the 24/7 news cycle.
God, it is a frenzy, isn't it?
It really is. So we want to look strictly at the cold, hard mechanics of how smart money, so institutional wealth, how that money behaves during a global crisis.
That's exactly right. And before we go a single step further, I think we need to set a very firm boundary for you, the listener.
Yeah, please do.
We are examining a highly complex, politically charged geopolitical conflict, but we are doing so strictly and entirely through a financial and analytical lens.
Right.
We're reporting solely on the mechanics detailed in the source material you provided us. We are not taking any political sides. We are not making moral judgments. And, we are certainly not endorsing any geopolitical viewpoints from either the left or the right here.
I think that is a vital distinction to make right up front. Capital doesn't have a political party.
Exactly.
And today, neither do we. We're just here to walk you through the playbook you shared with us. And let me give you the big tease right out of the gate, because the reality outlined in your research is incredibly counterintuitive.
It really flips the script.
It does. When a geopolitical crisis hits, everyday people, the retail investors, they tend to panic. But institutional investors,
They do not.
they do not. They follow a rigid, almost mathematical process. And once you see it, you really can't unsee it.
No, you can't. It's a completely different paradigm. I mean, the institutions are playing a long game of chess while the retail market is basically just reacting to flashing red lights on a television screen.
Okay, let's actually unpack this for a second, because the contrast between those two reactions is a bit jarring when you read it on paper.
It is.
According to the playbook in your notes, the typical retail investor reaction usually falls into one of three traps.
Right, the three traps.
Trap number one, they completely freak out and liquidate everything. They flee to cash, which, as the source points out, practically guarantees a loss because inflation is just going to eat that cash alive.
Yep, inflation destroys it.
Trap number two is that they just freeze in horror, like a deer in the headlights. They literally do nothing while their portfolio swings wildly.
Just paralyzed.
Exactly. And trap number three, which honestly might be the most dangerous, is the fear of missing out, the FOMO.
Oh yeah, the panic buying.
Right. They see the news and they panic buy defense and oil stocks right at the peak, which happens to be exactly when the institutional money is getting ready to sell.
We see that pattern repeat consistently. I mean, Gulf War, Iraq, Russia, Ukraine, and now with the current tensions. But to understand the institutional view, we have to look at a rather chilling concept from the text you provided.
The sociopath thing.
Yes. The source describes markets as acting like sociopaths. Now that sounds harsh, but it is a highly accurate metaphor.
It really makes you stop and think.
It does, because markets entirely lack emotional intelligence. They do not feel empathy, they don't feel fear in the human sense, and they certainly do not mourn. They only possess one thing.
Pricing intelligence.
Exactly, pricing intelligence. They are cold, calculating machines, trying to determine the future value of assets based on new variables. That's it.
I found that sociopath analogy jarring at first, but it starts to make sense when you look at the historical data. And I think this specific data point from the listener's notes is really going to comfort you if you're feeling anxious about the state of the world right now.
It's a great data point.
Historically, when a geopolitical shock hits, the market sees an initial dip of about 5 to 7%. But here's the kicker.
Yeah.
Markets typically recover to flat within exactly 35 days. 35 days,
Yeah.
and a year later, they are actually up 8 to 10%.
And that specific data point is exactly why institutional money doesn't gamble on breaking news headlines.
Yeah.
They know that initial 5 to 7% dip is largely an emotional retail reaction.
Mixed with some automated trading algorithms, right?
Exactly. The smart money simply waits. They wait for that initial shock to subside, they wait for the fog of war to lift, and they wait until the actual tangible scope of the conflict becomes clear.
They need the real picture.
Right. Once they can accurately model the structural reality, they pour their capital back into the market. They are buying when everyone else is selling in a panic.
Which brings us to the actual mechanics of the current conflict. Let's pivot to the specifics of the US-Iran situation. The notes you sent us highlight a specific production number regarding Iranian oil that makes this tension such a massive needle mover for the global economy.
Right.
Could you break down why that number is so critical?
Certainly. So Iran produces roughly 3.3 million barrels of oil per day.
Mm-hmm.
And what's fascinating here is how the market interprets that number.
How so?
Well, a single oil well in Iran doesn't even need to be physically hit by a missile for the market to react. Markets trade on perceived risk.
So just the threat is enough.
Just the mere threat, the perceived risk of that 3.3 million barrels being disrupted causes global traders to instantly price in higher costs. They have to assume the worst-case scenario for supply just to protect their downside.
And it's not just the wells themselves. The listener highlighted a specific geographic vulnerability in their research, a remarkably narrow body of water. Why is the market so obsessed with this one specific location?
You are referring to the Strait of Hormuz. And that's absolutely vital context for you to understand this conflict. It is a very narrow stretch of water, but roughly 25% of all the global oil supply passes through it.
25%.
Yeah.
1/4 of the world's oil.
Exactly. If there is any military action there, or even just the deployment of sea mines, you aren't just looking at a minor inconvenience. You trigger an instant, profound global supply shock.
Right.
And the market knows this, which is why they watch that specific body of water like a hawk.
Here's where it gets really interesting. Because you might be thinking, okay, oil prices go up, I pay more at the pump, that stinks. But the playbook tracks this incredible domino effect that higher oil prices have on the wider economy. It doesn't just stay at the gas station.
It is a highly interconnected web. Let's trace the dominoes. Oil isn't just fuel for your car. It is the primary input for global shipping. It powers agricultural machinery for food production. It is a base ingredient in fertilizers. It heats homes.
It's in everything.
Right. When the price of oil spikes, the cost of moving, literally everything goes up. This creates what economists call sticky inflation. It is inflation that digs its heels in and just refuses to drop.
Let me pause you there just to make sure I'm following. If inflation is sticky and refuses to drop, that forces the Federal Reserve's hand, right?
Yes.
They can't cut interest rates to help the economy. They have to keep rates high to cool things down.
Precisely. And higher interest rates mean expensive mortgages for consumers, sure, but more importantly, it means significantly higher borrowing costs for corporations. Let's use that relatable example straight from the listener's source material.
The data center.
Yes. Imagine a large tech company wants to build a state-of-the-art AI data center.
Right, and those facilities require billions of dollars in upfront capital. They aren't paying for that in cash.
No, they have to finance it.
Exactly.
If interest rates remain high because oil inflation is sticky, financing that AI data center might suddenly cost that company an extra $1 billion over the life of the loan.
Wow.
That is $1 billion wiped directly off their bottom line.
Yeah.
Their corporate profits drop, their cash flow shrinks. And that is the domino effect in action. When the S&P 500 dips during a Middle East conflict, it isn't just reacting to scary news on television.
It's actively pricing it in.
The index is mathematically pricing in the reality of lower future corporate earnings due to elevated borrowing costs.
It is entirely mathematical, the market sociopath at work. So knowing how cold and calculated this all is, how do we actually navigate it? The sources you sent us break down the wealth positioning into 3 distinct phases.
The 3 phases, yeah.
Let's walk through them. Phase 1 is the shock. The text describes this as violent and heavily driven by computer algorithms.
It is pure chaos on the surface. During phase 1, you will see the VIX, which is the market's fear index, spike well above 20. You will see gold prices rise sharply as a knee-jerk safety play.
And certain stocks get hammered, right?
Oh, absolutely. High growth, high risk stocks. Think of sectors like speculative biotech. They plummet because investors are dumping anything that requires cheap capital. My strongest warning to you during phase 1 is this. Do not buy the breaking news.
Don't do it.
You are competing against supercomputers executing trades in microseconds.
Okay, so if phase 1 is just algorithms violently reacting to headlines, how does the smart money transition out of that panic? How do we actually get to phase 2? The notes call phase 2 the repricing, but it seems like a very complex shift.
Well, if we connect this to the bigger picture, phase 2 is where the human element steps back into the room. This happens when the initial panic burns itself out.
Yeah.
Analysts and institutional investors stop asking what just blew up.
And they start asking,
They start asking structural questions. They open their spreadsheets and begin calculating a new, permanent baseline for the global economy.
Can you give me an example of what that calculation looks like in practice? Because calculating a new baseline sounds a bit abstract.
Let's look at shipping roads. Say a conflict makes a primary waterway unsafe. During Phase 2, analysts aren't looking at the explosion on the news, they're looking at maritime maps.
Okay.
They're asking, are global shipping routes going to have to permanently detour around the Horn of Africa? If so, how many extra days does that add to a journey?
And that costs fuel.
Exactly. How much extra diesel fuel does that require per cargo ship? They calculate those exact increased costs and update their valuation models for every single company that relies on overseas manufacturing.
Oh, I see. They are moving past the fear and going straight to the logistics. The notes also mention defense spending as a structural change during this phase.
Yes, that is another perfect example of Phase 2 thinking. Analysts will look at the conflict and ask, is the U.S. government going to permanently increase its spending on artillery ammunition to replenish stockpiles?
Right.
If the answer is yes, they model out what 5 years of increased government contracts look like for specific manufacturers. It is not a knee-jerk trade based on a headline. It is building a new mathematical reality for the world.
And once they figure out that new baseline, we enter phase 3, the rotation. This is where the actual wealth is made, or at the very least protected. Let's dig into the specific sectors highlighted in the listener's research.
This is the critical part.
First up is the concept of investing in shovels. I love this analogy. We aren't digging for the gold, we're selling the shovels. In this context, the shovels are energy infrastructure, pipelines, and storage terminals.
It is a brilliant strategic pivot. Everyone else is trying to guess the price of a barrel of oil, which is incredibly volatile. The smart money invests in the infrastructure that moves and stores that oil.
Collects the toll.
Exactly. These pipeline and storage companies essentially collect a toll on the movement of energy. Regardless of whether oil is at $80 or $120, the energy still has to physically move from point A to point B.
That makes total sense.
These toll collectors are often much more sustainably profitable and less risky than the oil producers themselves.
That logic tracks perfectly. And the second sector in phase 3 is defense stocks. But I noticed the source has a really specific caveat here. It suggests that just throwing a dart at a legacy defense contractor isn't the best play.
It requires far more precision. The reality of modern conflict is that governments aren't just buying bullets. They are signing 10-year contracts that create hundreds of billions of dollars in manufacturing backlogs.
So where should we look?
The source advises looking at the broader sector moves toward the future of warfare. Unmanned systems, AI-driven targeting, and drone technologies. That is where the institutional capital is rotating its defense allocation, because that is where the structural growth is actually occurring.
Before we move on to the final piece of phase 3, I need you to clarify something from the notes. We have to talk about gold versus oil.
Ah, yes.
The text provides some truly powerful data comparing how they behave after the initial shock. But it uses the term demand destruction when talking about oil. What exactly does that look like on a consumer level?
That is a great question. Demand destruction happens when the price of a commodity goes so high that people simply stop buying it, or they find alternatives.
Okay, give me an example.
For example, if gas prices spike to an extreme level, families cancel their summer road trips, trucking companies consolidate their routes. The demand for oil falls off a cliff because it is too expensive, and as a result, the price of oil crashes back down.
Got it. So oil spikes on the fear, but then crashes when people refuse to pay the inflated price. How does that compare to gold?
The data in the notes is definitive. Oil is highly reactive, usually spiking and then crashing within 6 months as supply chains adapt or that demand destruction sets in. Gold, on the other hand, has incredible staying power as an inflation hedge.
It just holds its ground.
Better than that. Historically, 6 months after a major geopolitical shock, gold doesn't just hold its value. It outperforms the broader market by an average of 19%. It stays elevated long after the oil panic subsides.
So what does this all mean for you, the listener, sitting at home looking at your retirement account? How do you protect the core of your everyday portfolio when all this macroeconomic shifting is happening?
The secret weapon here, and the source emphasizes this heavily, is pricing power. You want to fill your core portfolio with companies that possess immense pricing power. These are typically brands with very high gross margins.
Let's define gross margins quickly for anyone who might not live and breathe financial statements.
Simply put, a high growth margin means it costs the company very little to produce the good or service compared to what they sell it for. Think of a premium luxury brand or an essential software platform. Because their margins are so healthy, when the cost of energy goes up and the cost of global shipping goes up, these companies can pass those increased costs directly onto the consumer without losing their business.
They just raise the price.
Exactly. They can raise their prices by 5%, and people will still buy their products. They have a moat around their business.
And on the flip side, the text is very explicit about what sectors to avoid.
Yes. Avoid sectors that get systematically punished by high interest rates. The source specifically calls out utilities and real estate.
Because of the debt.
Right. Both of those sectors rely heavily on taking on substantial amounts of debt to operate, build, and expand. When rates stay high, because that sticky inflation we talked about earlier, the profit margins for utilities and real estate just get crushed by the cost of their own debt.
We have covered the financial mechanics deeply, but we have to touch on the psychological risk management, which your source dedicates significant time to. Because you can understand all the data in the world, but if your head isn't in the right place, you will still make mistakes.
It is arguably the most important piece of the puzzle. The most actionable advice I can give you is this. Turn off the 24/7 war coverage.
Yes.
Yes, be an informed citizen, but do not let your investment strategy be dictated by the relentless dramatic drumbeat of television news. It triggers your human fight-or-flight response. It actively prevents calm, rational decision-making.
It's designed to make you panic.
It is. The hard truth is that all the information you actually need as an investor is found in the money flow, not the breaking news ticker.
Let's summarize this incredible journey we've just been on. You brought us a masterclass in separating emotion from strategy. We learned that the market operates with pricing intelligence, completely devoid of emotion.
The sociopath.
Right. We saw the reassuring data that despite an initial dip, markets historically recover within 35 days of a shock. We traced the domino effect from the Strait of Hormuz to sticky inflation to your favorite tech company's AI data center.
It's all connected.
And we explored the institutional rotation playbook, investing in the shovels of energy infrastructure, looking at drone defense backlogs, holding gold for its historical outperformance, and anchoring your portfolio with companies that have unshakable pricing power.
This raises an important question for you to take away today. Knowledge is only valuable when it is applied with critical thinking and a completely cool head.
Absolutely.
The ultimate armor against geopolitical volatility isn't a secret stock pick. It is sizing your positions correctly so that no single event ruins you, managing your risk mathematically, and ruthlessly ignoring the dramatic headlines. Let the spreadsheets and the money flow tell you the story.
I want to leave you with one final, totally mind-expanding thought that builds on everything we just discussed. The notes you send in explicitly mention that phase one, the immediate shock, is already heavily driven by incredibly fast algorithms executing trades.
Right.
But think about the trajectory of technology. If market AI becomes so advanced that it can instantly and perfectly model the entirety of a global geopolitical conflict, calculating the shipping detours, the sticky inflation, the elevated borrowing costs, and the future corporate earnings in real time.
Wow.
Will we eventually reach a point where phase 2 and phase 3 happen in milliseconds? Will human investors, even the institutional analysts building those spreadsheets, eventually be priced out of the playbook entirely?
That's a fascinating thought.
Are we moving toward a future where AI simply manages the world's wealth during global crises before a human can even blink? It is a wild thing to mull over as you watch the markets open next week. Thank you so much for bringing in such phenomenal sources today. This is exactly why we do this. Keep digging, keep questioning the consensus, and keep learning. We will see you next time on The Deep Dive.